Welcome to the Kentucky Retirement System's Pension Spiking Update. This presentation will provide an overview of the Employee Pension Spiking Program established by Senate Bill 104. Presenting this information will be Ashley Gabbard with the Member Services Division and Suzanne Elphinstone with the Employer Reporting, Compliance, and Education Division. Before we cover the newly created Employee Pension Spiking, we will quickly review the employer pension spiking, which was created by Senate Bill 2 in the 2013 legislation. This pension spiking law became effective for employees who began retiring as of January 1, 2014, and is being administered on everyone who retired between January 2014 and June 2017. On the employer pension spiking, if a greater than 10% increase is found within the member's final compensation and there is no approved exemption to apply towards it, the employer pays the actuarial cost for that spike. There is no change to the member's credible compensation or retirement benefits. The cost of this spike lies solely with the employer. These employer pension spiking cases may continue to occur in the future due to recalculations on a retiree's benefit based on a correction found during the post-retirement audit. So while these are slowing down, they probably will not disappear as of January 2018 when the member pension spiking picks up. Ashley will now review the member pension spiking.
Thank you, Suzanne. As she mentioned earlier, my name is Ashley Gabbard and I'm a benefits counselor here at Kentucky Retirement Systems. Today we will be discussing Senate Bill 104, its new exemptions, and KRS's business procedures to handle employee pension spikes. Senate Bill 104 was enacted within the 2017 General Assembly. It only applies to members retiring on or after January 1, 2018. For anyone that retired July 1, 2017 to December 1, 2017, a grace period was given which did not penalize neither the member nor the employer for a pension spike. Unlike Senate Bill 2, Senate Bill 104 refunds the employee contributions back to the member due to the reduction in the member's credible compensation. Credible compensation is defined as compensation that must be reported to KRS and is used to calculate retirement benefits. Senate Bill 104 has new exemptions which we will be discussing later within this presentation, and it only applies to Tier 1 and Tier 2 members. Tier 3 member retirement benefits are not calculated based upon final compensation, and therefore they are excluded from the pension spiking rules. Credible compensation. New law considers credible compensation earned on or after July 1, 2017. As we become further and further from this date, the last 5 fiscal years of employment for the member will be considered when determining a pension spike. Any increase in excess of 10% from the immediately preceding fiscal year will be exempted from credible compensation when calculating the member's retirement benefit. Only if that fiscal year which spikes is to be used in the member's final compensation, KRS will refund member contributions and interest attributable to the reduction in credible compensation back to the employer. Senate Bill 104 does allow for some exemptions. If an increase is caused by a bona fide promotion or career advancement, lump sum payout from compensatory time at termination only, or lump sum payout for alternate sick leave payments. Before I move on to the next slide to discuss the remaining exemptions, I want to point out that while compensatory payouts at termination are exempt, the payout of a Block 50 is not. To continue on with the exemptions, an increase in years where the employee was on leave without pay in the prior fiscal year, or an increase due to overtime work and pay as the result of a state or federal grant pass-through, or a similar program that requires overtime as a condition or necessity of the employer's receipt of the grant. Lastly, an increase due to overtime work and pay required by a federal or state-declared emergency. While good record keeping has always been important, Senate Bill 104 relies on this even more. Upon the detection of a pension spike, a Form 6487 will be mailed to the employer to verify if the member actually spiked or if part of their wages should be exempt. Suzanne will be reviewing this form and the process in more detail further in this presentation. I'm going to take the opportunity over the next few slides to discuss some of the FAQs our staff has come across in administering benefits based upon Senate Bill 104. Question: if I work for multiple participating employers, can this cause a pension spike? The answer to that question is yes. In calculating a member's final compensation, we consider income from any and all participating agencies which a member averages 100 hours per month over a calendar or fiscal year within a system. For example, it's not uncommon to see an EMT work for both county and city. As long as the member averages 100 hours between the two positions, we would consider wages in both to determine a spike. Part of my final compensation was earned with KERS and part with teachers' retirement. Will the credible compensation I earned with teachers be used to determine if a pension spike exists? No. Only credible compensation from a system administered by Kentucky Retirement Systems will be considered when determining a spike. Kentucky Retirement Systems administers benefits for Kentucky Employees Retirement, KERS, County Employees Retirement, CERS, and State Police Retirement, SPRS. What if a member has a spike from 2018-19 to 2019-20, but the member continues to work 10 more years at a lower salary? At retirement, 2018-19 and 2019-20 are used to determine the member's final compensation. Will this be considered a spike? That is not considered a spike because only the last 5 fiscal years are evaluated to determine a spike. That could be confusing for some, as the final compensation for a Tier 1 non-hazardous employee uses their high 5 years rather than their last 5 years as the bill states. This may be a point of clarification you need to make with your Tier 1 non-hazardous employees. What if trailing wages cause a spike? Trailing wages are wages that are earned prior to termination yet paid after termination. They should be verified as such on Section H of the Form 6000. If verified correctly, trailing wages would not be used as part of the evaluation to determine if a spike has occurred. So how do we determine if a spike has been detected? At this time, our benefit counselors are calculating the spike by means of a spreadsheet. We compare the current fiscal year to the 2016-2017 year. In this example, the member earned $18,695 in fiscal year 4. From fiscal year 3 to fiscal year 4, the member's credible compensation increased 14%. Since Senate Bill 104 only allows a 10% increase, contributions will be refunded to the member on the excess 4%. If you were to hand calculate the cap for credible compensation, you would do so by taking fiscal year 3 and multiplying it by 1.1%. The maximum credible compensation that can be earned for fiscal year 4 in this example is $17,966.58. In calculating this member's final retirement, the counselor would manipulate fiscal year 4 by decreasing the credible compensation by $728.42. At this time, a letter would be mailed to the member and the Form 6487 to the employer. As mentioned before, our benefit counselors are manually calculating pension spikes. At this time, we are not mailing letters along with a benefit estimate if a spike is detected. Once our system is able to detect the spike and send letters automatically, it will be procedure for the member to receive a letter from KRS to warn of a potential spike. When an employee applies for retirement, the account must be evaluated for pension spiking. There are no exceptions. This procedure is already in place, and some of your employees that have applied for retirement may have received a letter from KRS in this regard. Once KRS receives the Form 6000, notification of retirement, the account is audited, and then the final retirement paperwork is mailed. Part of this packet is the Form 6010, the Estimated Retirement Allowance. If there is a spike detected, the credible compensation is automatically changed to reflect the limits, and a letter of explanation is sent to the retiring employee. The Form 6487, Request for Member Pension Spiking Exemption Amounts, is sent to the employer. This is where I'm going to let Suzanne take over the presentation to discuss procedures from an ERC standpoint.
Thank you, Ashley. Although Senate Bill 104 is being called the member pension spiking, the employer will still be called upon to verify any possible exemption amount for the member on the Form 6487. This form can only be signed by agency representatives who are set up as an agency contact with the Kentucky Retirement Systems. You can check who your agency has set up as a contact in the Employer Self-Service under the Account tab. We strongly recommend that the agency not only have their reporting official and human resources payroll contacts set up, but also their agency head. If you need assistance with setting up a contact for your agency, please call the employer hotline. The Form 6487 will be automatically generated when a retiring member is found to spike, and will be directly mailed to the primary reporting official for the agency once the member's paperwork is processed. If the agency does not receive a copy of the form and have received a notice that a form was sent, then contact the Employer Reporting, Compliance, and Education Division to have that form reissued. Once the form is sent to the agency has 60 days from the date of creation to return the completed form to the Kentucky Retirement Systems. Unlike the Form 6481 used in the employer pension spike, the Form 6487 must be returned to the Kentucky Retirement Systems, even if the agency is claiming no exclusions on this spiked salary. If we have not received the form, you will find a new report in the monthly packet called the Missing Form 6487 Report to advise that Kentucky Retirement Systems is still waiting for verification on the member. The Form 6487 is divided into 3 parts with 2 pages of instructions included. Part 1 is similar to the current Form 7112 that is mailed out on the employer pension spiking and will provide the details of the last 6 years of members' employment. It shows the actual credible compensation reported, the spiking increase, and the adjusted credible compensation. The agency is asked to check a box at the bottom of Part 1 to indicate whether the increase in the actual credible compensation is attributable to an allowed exemption or if there are no exemptions. In Part 2, the agency will provide the total exemptable salary amount in the fiscal year related to a bona fide promotion or career advancement, overtime due to a state of emergency, and overtime due to a state or federal grant. If the spike has occurred due to a leave without pay in the prior fiscal year, an alternate sick leave payout, or a lump sum payout of compensatory time at termination, you need to contact the Employer Reporting, Compliance, and Education Division as directed in Part 1. Part 3 will need to be completed if the exemptable amount is due to a bona fide promotion or career advancement. On this page, we ask you to provide us with the title of the job prior to the promotion or advancement and the title of the job after, as well as the effective date of this promotion or advancement. Then you may describe the job duties in the fields provided, or you may include copies of the job descriptions from the agency's personnel manual. We also request that you provide the rate of pay for each position in the fields requesting the description of the job duties. After you have completed this form, please return it to the Kentucky Retirement Systems. Once the form is received, we will review the information and remove any exemptable amounts from the fiscal years at spike and recalculate to determine if the exemptable amount reduces a spike below the 10% limit. If the Form 6487 shows no exemptions, or if the exemptable amount does not reduce the spike below the 10% limit, then the member's credible compensation in the spiking year will be reduced to bring it to the 10% level. When a member's credible compensation is reduced, the Kentucky Retirement Systems will refund the associated employee contributions on that amount. If the contributions were withheld and reported as pre-tax, then this refund will be returned to the agency via a new invoice called the Member Pension Spiking Refund. The reason the refund will be returned to the agency is so the appropriate payroll taxes can be withheld from the refund before it is returned to their employee. If the agency needs assistance in finding a current address on the employee, they may contact the Employer Reporting, Compliance, and Education Division. If a current address cannot be found, the agency can register the refund as unclaimed property with the Kentucky State Treasurer. If the contributions that are being refunded were submitted to the Kentucky Retirement Systems as a post-tax payment, then the refund will go directly to the member. The member will first receive a letter explaining why the money is being refunded and how the refund will be issued to them. The agency will not have any interaction with this refund in this instance, and if the member calls the agency regarding the refund, they should direct them to the Kentucky Retirement Systems member hotline. The only contributions that will be refunded due to a reduction in the member's credible compensation caused by a pension spike will be the member's employee contribution, which is 5% for the non-hazardous employee and 8% for the hazardous duty employee. The additional 1% that the Tier 2 members pay does not get refunded to the member, nor does the employer contribution get refunded to the agency. The employer contribution is retained by the Kentucky retirement systems to help pay down the unfunded liability per statute. Thank you for viewing the Pension Spiking Update presentation. If you are a member and have questions about a personal account, please contact the member hotline. If you are an agency and have employer reporting questions, please contact the employer hotline.